Okay, we're going to go ahead and get started. Again, welcome to our Sacramento Homebuyer Workshop. In case you didn't hear my welcome earlier, my name is Jason Maida. Really excited to bring this information to you. We get a chance to teach these workshops just about every week through our offices here in Sacramento, and we teach in different markets. So if you got a chance to join our class by visiting mortgageeducate.com, you'll get a chance to see all of the different classes that we have upcoming over the course of the year. So thanks again for taking some time out in your busy evening to be able to join us. So as I mentioned earlier tonight, we're going to really try to make this an interactive session. So we really encourage questions as we roll through tonight's content. So please use the question box, the Q&A box, and then we'll answer some of those questions on air and bring those back to the larger audience. Just a quick little bit about me. I manage our American Pacific Mortgage here in Sacramento office, and I get a chance to originate and help clients throughout the community. And we specialize in helping first-time homebuyers. And so what you're going to hear a lot of tonight in our teachings is around some of the assistance and resources that are available to you as first-time homebuyers. So we're going to speak to the CalHFA Assistance Program. There's some really cool things that are actually just launching this week with CalHFA. They actually launched on Monday. So I'm going to share that with you during tonight's class. We'll also look at some different core products that can help you as first-time homebuyers, conventional loans, FHA, VA, USDA loans. So we'll get a chance to look at that. We're going to also spend some time looking at the workflow of buying a house. What does it look like to go from pre-approval all the way to getting your keys and celebrating the huge accomplishment of homeownership? So we're going to learn a lot tonight, and we're going to dive right in right now. One thing I just want to make mention, we do have one of our preferred realtors joining us tonight, Melissa Allman with Mega Bliss Real Estate right here in Sacramento. We've asked her to join us tonight to be kind of like a panelist for us. So as we roll through tonight's content, if you do have some questions, you can just put them in the Q&A. And if they're for me or for Melissa, we can go ahead and handle those. There's a lot going on in the housing market, as you can imagine. And so Melissa's, just a great resource to be with us this evening to be able to answer some of those questions that pop up. So Melissa, thanks so much for joining us this evening. Here's some of our talking points for today. So we're going to look at the housing market, as I just mentioned. I'll kind of give you my perspective and kind of share with you what we're seeing as we're meeting with clients. We're going to look at, does buying make sense? And we're going to do a quick budgeting analysis here in just a minute. We'll also spend some time looking at credit and how we can make sure that we're optimizing credit to be in the best possible position for our home buying. We'll talk a little bit about student loans and what's that look like from a qualifying perspective. We'll look at loan programs, so the conventional loans, FHA, VA loans, all the different products and resources that are available to you as first-time home buyers. We'll spend just a little bit looking at qualifying income and some of the documentation you'll need. Also looking at assistance programs through CalHFA. And then we'll wrap up tonight's discussion looking at the loan process, some of the terminology around home buying, and finally, what does a personal consultation look like in getting you prepared to purchase. So as we're preparing and kind of figuring out how we're going to make probably the largest purchase in our lifetime, we want to figure out, does it even make sense for us to switch from our current housing situation to looking at home buying? And so when we think about home buying, there's some great benefits that come along with it. You can create stability with your house payment. No longer do you have to worry about maybe your rent going up by another $50 a month when you sign a new lease. This is an asset, so you have the ability to be able to pass along this asset to the heirs of your estate. This is wealth. As your home grows in equity, that's appreciation. So the difference in what you owe on your house versus what it's now worth in the market, that creates wealth. And if we look at some of our first-time home buyers that purchased with us like the last 2, 3, 4 years, they've made significant amount of wealth in the equity. So many of those have decided to sell because they've made so much money on their home. But at the end of the day, buying a house is not necessarily about growing wealth. It's about creating sustainable and affordable home ownership. And finally, there's some tax benefits that come with home buying. And even though there were some tax changes in 2018, there's still potential tax deductibility that comes with interest on a mortgage. So a lot of great things that come with home buying. And as we're kind of doing our analysis and kind of figure out what this looks like for us, I want to take you through just a budgeting calculator that's brought to us by Freddie Mac, and it's a rent versus buying tool. And so we're gonna jump out to this tool and kind of just walk you through an example of what it could look like for you. By the way, all the material that I share with you this evening as we go through our class is all going to be shared with you tomorrow morning. So be checking your inbox, because the whole presentation that I share with you this evening will be available to you. Now, I really encourage you to try to take good notes so you can have a lot of good information and have a good takeaways from tonight's discussion, but you will get all material that I share this evening tomorrow. Okay. All right. Okay, let's go ahead and jump into this budgeting tool, and we're going to kind of build a home buying scenario for us right now as we kind of walk through it. So because we're teaching a Sacramento class tonight, I'm going to kind of use more of Sacramento numbers based upon all the hundreds of consultations I've done with clients locally. So let's assume we're going to say a monthly rent of like $2,000 in rent. Okay. Now we're going to plug in for our renter's insurance. We'll assume $15. We're going to assume rental increase of about 3% per year. Home prices, that can vary, but for this scenario, I'm going to put in $500,000 for our purchase price. Okay. Down payment minimum is 3% at $500,000. You're going to learn a little bit more about what that looks like in just a bit. Property taxes. Generally, property taxes are going to be, how we calculate that as a lender is 1.25% of your purchase price. Okay, so we're going to just do some rough math. We'll say about $6,250 per year in property taxes. Homeowners insurance, roughly about $1,000 on an annual basis. And now we also earmarked maintenance, because obviously when you buy a house, no longer you're going to be able to contact your landlord to be able to get repairs done at your house. You're gonna have to kind of budget for those repairs yourself. And then finally, loan information. 30-year fixed mortgage. We're gonna assume an interest rate. Now this is our last presentation. We had 4.5%. We're gonna put 5%. Unfortunately, we've seen the average interest rate really tick up over the last week. So we're gonna spend some time learning a little bit about what's going on with the interest rates in just a bit. Origination charges. That's gonna be what your lender will charge you. As American Pacific Mortgage goes, we have a $995 underwriting fee plus a $910 processing fee. Now, if you're joining us through some of our partnerships that we have, if you're a state employee or maybe you attended UC Davis or some of our other university partnerships, there's a discount program that takes that processing fee from $910 all the way down to $160. So we can learn a little bit more about that in tonight's discussion. And then overall, when we purchase a home, we want to think about not just saving for our down payment, but we also want to look at closing costs. Closing costs are usually going to be about 2 to 3% of your sales price. And so when you see this kind of line item here as other settlement services, that's going to be cost of maybe title, escrow, transfer costs. So we want to factor that also into our monthly budget, into our budget of purchasing. The last tab here is other assumptions, appreciation rate, how long I'm going to be in the house, the selling cost. Let's kind of talk a little bit about here. Now, when you sell a home, and we're gonna assume that we're going to sell the house 7 years from now. That's what this analysis is going to show. But when you sell a house, you are going to have to pay for the realtor commissions for the buying agent that represents you, as well as the agent that's selling your home. Now, as a buyer, so if you have someone like, let's say Melissa represents you in your home purchase as a buyer today, her commissions are paid for by the seller. So I really think it's a great a resource to have for you when you're negotiating with sellers, to have a buyer's agent represent you. And plus they're going to be experts in the market. So, but as a buyer, that's not something to come out of your pocket at this point, but eventually when you sell, that'd be an expense that you would have to have come from your proceeds. And then state and federal tax rate. And then we're also going to factor in the savings rate. So what this analysis says is that, if I continue to rent roughly at about $2,000 a month versus my mortgage payment. Now my mortgage payment's a lot higher because it's going to be closer to $3,700 a month. My opportunity of buying over renting is it's about a $32,000 opportunity in the next 7 years. Now, if I'm paying a lot lower rent and I'm paying and I'm have a bigger difference between my rent and my new buy monthly payment, then I'm going to create a bigger opportunity for myself. Now, so for some of my clients that are, or I should say, it won't be as big of an opportunity, but for some of our clients that are maybe renting a room at $500 a month and now jumping into a $500,000 home purchase, those numbers might not make as much sense. But if I'm going to move from, let's say, renting at $1,500, I'm just going to change these numbers around a little bit, and now I'm going to go maybe buy a $350,000 house. And that might not be as attainable, you know, in the Sacramento area, but you see the numbers may not be as favorable for us. So it's really going to be dependent upon what it looks like from a rental perspective for us. Okay. For those of us that are maybe paying higher rent rates, maybe it's closer to $2,500, and now we're going out and jumping out and buying a $350,000 house, then certainly that would make a lot more sense to be buying. And what's interesting in the market right now, we're seeing rental rates get really close to what the buy side looks like for a lot of our potential homeowners. We used to see the difference being $1,000 to $1,500, but really right now we're seeing maybe payment differences of $500 to $700 when we're doing the same budgeting tool with some of our clients. Okay, so that's our rent versus buying calculator that you guys can take a look at on your own time, and we'd be more than happy to walk you through that as part of a consultation. By the way, as I go through tonight's content, you're going to hear me reference consultations. That's a one-on-one we do with you to help build a home buying game plan. A lot of the ingredients we share with you in our teachings in these classes, but it's a kind of a personalized home buying game plan so you can really figure out what it looks like moving forward with you and that journey towards home ownership. So let's talk a little bit about the housing market. And, you know, for those of you that are, you know, on Zillow or Redfin, or maybe you're talking with your local realtor, clearly it's a high demand market, and we're seeing just rapid appreciation across our market. This slide really kind of highlights what's gone on over the last decade in home ownership, but I want to kind of concentrate more on this area right here. If you look at this 2020 gray bar here, obviously represents the start of the pandemic and kind of what we saw, and just this rapid increase in home appreciation. What led to a lot of that was obviously little or minimal inventory to support the demand from buyers. And we really had this move from buyers' mindset of switching from kind of renting being okay to maybe I want to move towards home ownership. The lower rate environment really sparked a lot of that, but also kind of the change in employment. More remote opportunities for workers came about with the pandemic. And so that kind of switch of, you know, hey, I don't have to commute. Now I can maybe live in Sacramento and still work in my job in the Bay Area. A lot of that stuff came about. And so then you see kind of huge housing appreciation. And we just didn't have the inventory to help support the buyer demands. Now we are in the spring buying months, so we'll hopefully going forward see a little bit more options available for first-time home buyers and our second and third-time buyers. And then the demand is still increased, but we'll see what happens, because one of the things we're going to talk about here in just a minute is what's going on with interest rates. And maybe that does change a little bit about what's going on in the market, because no longer we have buyers that are going out and pre-approved at 3.25% rates. Now we're looking at, you know, high fours, maybe 5% interest rates. And that does change a little bit of the purchasing power. So sellers may not be able to get the top dollar that they once were achieving in the marketplace. So it'll be really interesting to see over these next several months how the rapid increase in interest rates has maybe changed the market. Because as we're seeing it right now, is that, you know, you can see this on this slide here. We're seeing this, you know, this trajectory of the housing market starting to kind of do this curve. So, you know, we had 20% appreciation last year. The projection this year is like 5% appreciation. Now it's still not bad. 5% appreciation is awesome, but, you know, we are starting to see a little bit of tapering here in the appreciation market. So the good news is for us as first-time home buyers that hopefully this will lead to new opportunities, more of a level playing field. So no longer are we competing against 30 or 40 other buyers, but maybe it's 10 to 12 buyers. And since you guys are joining us from Sacramento, you guys can appreciate allergies. And so, by the way, throughout tonight's class, you'll probably hear me sniffling a little bit because I have the wonderful allergies of Sacramento. That's the joys of living in the Valley. So, all right, well, let's go ahead and talk a little bit about interest rates, because you've heard me reference that a little bit. That's just such a hot topic right now as I'm meeting with clients throughout the day. And the average interest rate is running right around 5% currently. And so when we're looking at that, and especially our buyers that were pre-approved over the last year, maybe haven't quite found a house, and maybe they're pre-approved at 3.5%, but now we're at 5%. We really got to sit down and kind of talk more about that budget, because it is changing their purchasing power. There's no question about it. What's leading to higher interest rates right now? Well, a lot of it's what we're seeing as a community: higher gas prices, higher food prices. Inflation is really hitting our communities and is putting some pressure on interest rates. And so we've really seen a bigger spike in interest rates than we were forecasting this year. We did think interest rates would hit into the maybe the 4 range. We started off the year in the 3.25 to 3.5. We thought we'd probably end up somewhere in the high 3s, maybe touch down at 4%. But sooner than we know that we saw interest rates move to 4.25, 4.5, and now we struck 5% just last Friday. The markets still remain very, very volatile. I think what's, the concern right now is that, the federal funds rate is they're projecting another 6 possible increases in the Fed funds rate. And that's kind of scaring the bond market, which controls what's going on with interest rates. And so we're seeing that really spike quickly, a lot quicker than we expected. Now, the question is, does this kind of level out at some point? And so I think that's where a lot of consumers are a bit concerned, whereas where does it end? Do we go to 5.5 or 6% interest rates? We just don't know where the end is. Some of the forecasts we're seeing is that hopefully things will start to level out as we get further along in the year, but at least in the next 30 to 60 days, a lot of our clients that are currently in escrow, we're recommending for them to lock in their interest rates right away. The other thing this chart shows, whoops, let me just back up for a second. The other thing this chart shows is kind of as we look at the blue line here, we're seeing this is the 30-year fixed mortgage, and obviously you can see the upward movement here. The other 2 lines represent, the orange is the 5/1 arm, the green is the 15-year. 15-year will generally stay lower than the 30-year. You got about a 0.5% spread between the 15-year and the 30-year. So it's really long-term rates that are being impacted. But in a high rate environment like this, or I shouldn't say high rate, but rising rate environment, because it's all relative, especially if you look at the rest of the slide, is that clients will ask about adjustable rates being lower. And what's interesting is you don't see a huge difference between the adjustable rate and the 30-year fixed. And especially for us as first-time home buyers, we just don't want to really look at an adjustable rate, because ultimately an adjustable rate has an adjustment period. In this particular example, we're showing a 5-year fixed. So after 5 years, that rate would adjust up to the market. So it's just not a good recipe for success. So I really recommend, especially for our first-time buyers, to be looking at 30-year fixed mortgages. So one of the questions we get is how is our interest rate? How do we come up with an interest rate? What are the ingredients to interest rate? Because all programs don't have the same interest rates. All clients aren't able to achieve the same interest rates. So there's a few different ingredients to that. Credit score plays a factor in your eligibility for an interest rate, the type of program that you're going to utilize, how much you finance, how much you put for your down payment. So if I put 3% down versus 10%, that can make a difference in my interest rate. You do have the option of buying a lower interest rate. That's called costs or points. And what a point is, it's 1% of your loan amount. So if I'm financing $400,000 and I'm paying 1 point, that's 1% of my loan amount. So that'd be $4,000. And that's something we want to look at as, as an option potentially, but we want to make sure there's a good return on our investment, because if you pay a point, 1%, that adds additional cost to the financing. And then as we look at the last kind of bullet point here, it's term. And you guys kind of learned about this just on the last slide, which is the type of term you select. So whether it's a 30-year loan, 25, 20, or maybe even a 15-year fixed loan, that can change the interest rate offering. Generally speaking, the lower the term of the loan program you're taking advantage of, the cheaper the interest rate offering. Okay. All right. So one of the big factors that comes to play in interest rates is credit. And as we consult with our clients, it's really our job to help you optimize your credit and make sure we have you in the best possible position, because we really want to make sure we have the most reasonable and affordable financing for you as a future buyer. So let's take a look at what credit looks like and kind of the weighting of the FICO score calculation. So we draw our attention to the kind of the right side of this slide. So 35% of the credit score is how I've paid my bills. Now, when the credit agencies look at the credit score, the delinquencies of credit are looked at 30 days late, 60 days, and 90 days. So especially in the last 12 to 24 months, they're going to focus in on what that pay history looks like. Now, it's the biggest weighting of the credit score. So that's why it's so important to pay our bills on time. 15% of it's going to be how long I've had credit. So the more mature my credit file is, the better technically my score would be. But it's only 15% of the weighting. 20% is going to be how much credit I've tried to newly acquire. So any new accounts I've opened up, as well as new inquiries. So that's kind of a hot topic as I meet with clients, because there's a difference in inquiries. There's a hard inquiry and there's a soft inquiry. Soft inquiries and soft inquiries is how we begin our process. That just gives us as lenders visibility to your credit. It does not impact your credit score. However, a hard inquiry can impact your credit score. So you want to be really careful that you don't have too many hard inquiries. Now, the credit rules for mortgage and auto is that if you apply with as many auto lenders as you want in a 30-day window of time. So let's say I make an inquiry with the auto lender today, that starts day one. I have 30 days to apply with as many auto lenders as I want. It's the equivalent of one credit inquiry hit to my score. Same thing holds true for mortgage. Okay, so that's something just to keep in mind as maybe you're shopping around for different interest rate offerings from mortgage lenders. Okay, so the next weighting for the credit score is how much I owe. That's also known as utilization. So we're looking specifically at revolving credit. So if I have $10,000 in credit limits and I have a $5,000 credit balance, then my credit utilization is 50%. Ideally, we want to try to keep that utilization below 10%. Now, if maybe we're running a little bit higher in utilization, maybe we're at 70 or 80%, our big goal is to try to get that utilization below 50%. That's going to give us the next opportunity of improvement for our credit score. So let's talk a little bit more about utilization, maybe a kind of a tip or a trick that you can utilize to help kind of maximize utilization. So when each of you look at your credit cards, and maybe as a homework assignment, you can take a look at your credit card after tonight's session. When you look at the billing cycle date of your credit card, let's say it's on the 20th of the month, you also have a due date, right? That's when you make your credit card payment. The 20th billing cycle date, that is the date at which your credit card issuer sends out the data to the credit agencies. And one way of trying to lower your utilization and improving your credit score is try to pay off or pay down your balance before the end of your billing cycle date. So in this case, if my billing cycle is the 20th, try to pay off or pay down that balance before the 19th. Because let's say I just charged a trip to Hawaii and raised my credit balance to $5,000. If I can pay off or pay down that $5,000 balance before the 20th, then whatever that remaining balance is, that's what gets reported out to the credit agencies. So often when I'm talking with clients during their consultations, I look at their credit cards as part of their credit review and they say, well, Jason, I pay those off every month. And they probably do, but the problem is they're paying them off on their due date, so they're not getting the benefits of a lift in their credit score. So just kind of a takeaway on that, if you can pay them off by the billing cycle date, that's going to help give you a little bit of improvement in your credit score. Okay, so kind of going back around programs and credit scores. So every program has a minimum credit score. So FHA loans, as you can see here, are 600. We can go down to a 580 credit score. Conventional loans are usually 620. VA for our veterans that have served is 620. And then the CalHFA loan, which we're going to talk about in just a bit, is a 640 minimum score. Other things we want to think about with our credit score, if you've had past challenges, maybe a bankruptcy, foreclosure, some late payments, like I said earlier, the recency of those are going to be most impactful in the 12 to 24 months from the date of that event. And then account closure is something that comes up every once in a while. So if let's say you've paid off a bunch of your credit cards and you decide to close out those credit cards, you got to be careful with that, because when you close out the credit cards, there's two things that can be impacted in the credit score. One is your utilization can go up because you don't have as much access to credit. Two is your length of credit, especially if you've closed out older accounts, can be impacted because now you don't have as mature of a credit file. So just be careful before you do balance transfers and close out accounts or whatever. Make sure you have enough active trade lines. Last thing I want to touch on before we move from the credit slide is how we look at credit scores for clients. So as a lender, when we eventually do the hard credit inquiry, we look at all three agencies, TransUnion, Equifax, Experian, and we take the middle score of those three scores. So let's say I have a 740, 720, 700. I'm taking the 720 credit score to evaluate my qualifying. Now, so that's my middle score for me. Now, if I apply with my partner and my partner's 760, 740, and 720, my partner's 740. However, in lending, we always take the lowest middle score between the two of us. So then we would default back to my 720 credit score. And that kind of methodology usually holds true for all programs, interest rates, mortgage insurance, as well as assistance programs. So when we look at negative items on our credit, this is how long they'll generally stay on your credit report. So credit inquiries, usually 2 years, late payments, 7 years. Like I said, the impact is the most recent 12 to 24 months, but they will stay on the credit report for 7 years, charge-offs, things like that. Bankruptcies, 10 years or less, and then federal student debt is usually it's going to be on your credit report indefinitely. Okay, I think we had somebody ask a question about student loans, so I think that came up in the chat. So we're going to spend some time talking about student loans. For the student that or audience member that asked questions about student loans, if I miss something, please chime in and we'll circle back to it. So student loans are something that come up quite a bit in our consultations with clients. I believe most federal student loan debts are on forbearance until June. And so usually when we're looking at loan options for clients, we're going down either two paths, conventional loan or an FHA loan. And there's two different approaches to how we calculate those payments based upon the program offering. With conventional loans, if you're on an income-based repayment amount, and let's say you have $75,000 in debt, if the IBR payment or income-based repayment amount is $250, that's the amount we're going to use to qualify you. Now, if you haven't entered into an IBR payment, the default is 1% of the balance. So that would be $750. So we try to encourage clients to get into an IBR payment if they're going to start repayment, because that'll obviously help them get to be able to maximize their qualifying. So that's something to kind of keep in mind. Now, if you're back in school and your loans are in deferment, we still have to count a minimum payment against you for qualifying. And hopefully we can use the IBR payment. Now, on an FHA loan, it's a little bit of a different approach. So if I have the same $75,000 worth of student loan debt, the default is 0.5% of the balance gets counted towards a payment. If I'm on an IBR payment, income-based repayment amount, I can still use that payment if that's the lower option. So $250 for an IBR payment, maybe it's 0.5% would be $375 for the default payment. Okay, so if you have other questions we get is, if I'm on forgiveness because maybe I'm working for a nonprofit or I'm in healthcare, they can be forgiven in the future, but from a qualifying now perspective, we would still have to count those into the qualifying numbers. Okay, so for the audience member that asked that question, hopefully I was able to be able to answer that for you. Did I miss anything on that, Ken? No. Okay. Okay, and then like I said, if I need to circle back to the student loans, we could certainly do that. We did extend the forgiveness to August. Oh, we did? Okay, so the forgiveness, I guess, is extended to August. I think I said June. So, but you guys probably are well aware of that. Okay, let's go ahead and continue on. I want to talk a little bit about loan programs, and these are kind of the 5 core programs that we generally look to for our home buyers. We're going to spend most of our time looking at conventional loans and FHA loans, but we also offer VA loans for our veterans that have served, USDA loans. Those are going to be more for our remote areas, some of our rural areas. They're kind of all geographically specific and they have a little lesser income limits, but there's certainly an offering that we have for clients. Jumbo loans, and let's talk a little bit about jumbo loans, because jumbo loans are going to be for our clients that are looking to purchase beyond the maximum loan limit of $675,050. And so that has a slightly higher down payment. It's going to be a minimum of 10% down payment. And jumbo loans, while not common for first-time buyers, is certainly something we can take a look at as an offering. Now, there's one thing that we always like to point out with our clients when it comes to the asset requirements for jumbo loans. So not only do we have to save up our 10, maybe 15%, 20% down payment, plus our closing costs, remember that was 2 to 3% of our sales price, but we also need to have additional assets in the form of reserves. What reserves look like, it's going to be additional assets that I have left behind after I've contributed that down payment and closing costs. They can be in the form of 401ks, 403bs, cash accounts like checking, savings account, that's completely allowed. The reserves are generally 12 times your monthly payment of your mortgage. So let's make the math really simple. Let's say I have a $5,000 mortgage payment and it's a 12-month reserve requirement, that means I need to have $60,000 in assets made available. Okay. Let's talk a little bit about conventional and FHA loans, and I'm going to give you some of the differences as it relates to PMI with those typical products. So conventional loans have a minimum down payment of 3%. Once we get beyond the conforming loan limit of $647,200, that minimum down payment jumps from 3% to 5%. And those loans will go all the way up to $675,000. Now that does vary by county. So if you're joining us maybe from our Southern California markets, that's a high balance limit. I think that goes up to $970,000, $200,000. Now FHA loans have a minimum down payment of 3.5%. That goes all the way up to the max loan limit. And I had this conversation with a client earlier today because it gets a little bit confusing for some of our buyers. So we go up to the conforming limit of $647,200. That's a 3% down payment. But once we stretch beyond that loan limit, then we enter this space called high balance. And that's where that minimum down payment jumps from 3% to 5%. Now, as you heard earlier, the minimum credit score on a conventional loan is 620. FHA is going to be 580 to 600, depending on how your loan is structured. Now, with conventional loans and FHA loans, when you put less than 20% down, you're going to have what we call as mortgage insurance. And there's different kind of perspectives on mortgage insurance and kind of how we structure mortgage insurance. And so I like to, during our classes, to kind of show you what mortgage insurance looks like and the effect for you as a future home buyer. I want to spend some time looking at conventional, and then we'll spend some time looking at FHA. With conventional loans, you have a few different options when it comes to mortgage insurance. You can pay it back monthly. There's what we call a split mortgage insurance, where you can pay some of it monthly, you can pay some of it up front. There's single premium mortgage insurance, and that's where you basically pay for it all up front as part of your out-of-pocket expense. There's lender paid mortgage insurance, and that's where your interest rate goes from, let's say, 5% to 5.25%. The cost of the mortgage insurance is built into the interest rate. Now, when we look at mortgage insurance for a conventional loan, there's kind of three factors that will drive the cost of mortgage insurance. One is credit score. So that's why it's really important to help us maximize our credit score. The amount of down payment, so whether it's 3% or 15%, that'll change the premium. And then finally, loan amount. So the less I finance, there will be a cheaper premium. Generally with conventional mortgage insurance, there's a cancellation option. So once I have at least 2 years in the home and 20 to 22% equity, I can apply to have the mortgage insurance canceled. Now, I've included an example of a conventional PMI payment scenario below. One thing I do hear from clients quite often is that when I go on online calculators like Redfin or Zillow, the mortgage insurance is like $300, $400, $500 a month. I think what I'm kind of doing some research on those, they're just taking very conservative values on those. They're not using like really the characteristics that make up mortgage insurance. So like, for example, if you look at a $450,000 purchase price, putting the minimum 3% down with a 740 credit score, that PMI is going to be about $183 per month. And if you do it maybe on Zillow or Redfin, it might come out to $300 or $400 a month. So, we're more than happy to take you through some different calculations. In fact, part of your consultation will help run different scenarios for you. But as you can see, it's not as expensive as you might think. The more you put down, the higher credit score, that 183 premium will start to come down a bit. Now, if we look at FHA mortgage insurance, it looks a lot different. And here's the way mortgage insurance works with FHA. So you do have a monthly premium, which is based upon 0.85% of your loan amount. So we take that times 0.85% divided by 12. That's how we come up with the premium. But with FHA loans, you also have upfront mortgage insurance, which is 1.75% of your loan amount. So that gets added on. It's not an out-of-pocket expense, but it increases the amount of finance. So of course, that's going to impact your monthly payment. With FHA loans, the mortgage insurance cannot be canceled unless you refinance. So if you refinance from an FHA loan to a conventional loan, then of course you would be able to remove the mortgage insurance. When we look at the cost of mortgage insurance, so let's take that same $450 loan amount. We're going to have to factor in the upfront mortgage insurance, which is $78.75. So that's 1.75% of that $450. plus the monthly mortgage insurance, which is $324.32. So, we got about $140 difference between conventional and FHA that we want to keep in mind. Now, you may ask yourself, well, why would I want to look at FHA over conventional? Well, there's a variety of different reasons. FHA, as you heard earlier, has a lower minimum score. There's more leniency from a guideline perspective. So let's say I had a bankruptcy that was 3 years ago. FHA would be accepting of that, whereas a conventional loan would require 4 years seasoning to be able to be available for a conventional loan. Or if I had a foreclosure and it was, let's say 5 years ago, FHA would allow that, whereas conventional would want to require 7 years seasoning. So there's a variety of different guidelines that would, match better for each client's situation. So that's our job as kind of we design that home buying game plan to figure out what makes most sense for you. Here's those new high balance limits. By the way, the limits are adjusted every year based upon census data and median income levels and all that stuff. And so right around November, December of every year, we'll be posting those. You'll see them in some of our social channels. And of course, we'll teach them in our workshops, but these are for our surrounding counties. So not a lot of variance between Sacramento to El Dorado. When you get into the Valley, you see some lower limits. But if you are joining us from the Bay Area, the limits, of course, are a bit higher because of the cost of living. I just want to make sure that, did I miss anything? Questions?
No, we're listening.
Okay. Do you want me to answer this question?
Yeah.
Okay. So just one question came up since we just were talking about FHA. So the question was in, this audience member hears that FHA loans are getting priced out because of bidding issues. And so, is that a true question? Melissa actually can Melissa answer that live?
I don't think she's...
Okay. Melissa, I'll have you just answer that in chat. I'm going to kind of bring it live because I don't think we can put you on audio. Okay. Yeah. If you want to just post in the chat, Melissa, your perspective, I'll kind of give my thoughts because, we're obviously work with FHA loans. So, I think that's a bit of a misconception out in the market, honestly, because especially with this market starting to turn a little bit, I'm seeing, more and more FHA loans being accepted by buyers. I think the misconception is more around appraisals because appraisals can be a bit more stringent for FHA appraisers. So if there's, siding that has chipped paint, FHA wants that fixed, or maybe a conventional appraiser would be able to look past that. FHA loans will require all plugs to be working, so electrical outlets, where maybe a conventional loan may not ask for certain things like that. So I think sellers only know based upon the information they get from their realtor that's representing them. But at the end of the day, FHA loans are a great acceptable way of getting financing for clients. And I think as we kind of move through this market, you'll probably see some changes on the perspective of that. Okay. And if we need to kind of elaborate more on that, I know Melissa's going to be chiming in on that as well. Let's talk a little bit about some of the documentation needed when it comes to setting up your financing. So for our W-2 wage earners, usually it's last 2 years of taxes, W-2s, 30 days of pay stubs, and then we're going to do some type of verification of employment. So that's pretty standard. It gets a little bit more complicated for self-employed because we're going to require 2 years of taxes, depending on the type of business you have, profit and loss statement, balance sheets. And then we'll have to verify the business, maybe in the form of a business license, maybe a CPA letter. Now, if you're working as a W-2 employee and you also have a side business, maybe you're driving for Uber, or you have some type of online e-commerce business, or whatever the case may be, in order to count both sources of income, so maybe your 40-hour work week job plus your self-employment, we do have to show that you've been working both jobs simultaneously for 2 years. And that kind of approach holds true as well for dual employment. So if I'm in the healthcare industry, I work 30 hours at one clinic, 30 hours at another. I have to show that I've been working at both jobs for 2 years in order to count both sources of income. Okay, so that comes up quite a bit. Another thing that we hear from clients that maybe kind of pushes them back a little bit from buying is they think that they have to be on their job 2 years to be able to qualify for a mortgage, which isn't the case. We just require 2 years of either in the job or educational, past education. So what that means is, let's say I went to Sac State for the last 4 years, got my accounting degree, and now I'm just starting my new job with Deloitte here in Sacramento, and I'm just starting, right? Because I have 4 years of undergrad that supports my new career path with Deloitte. So that would satisfy the 2-year requirement. The other thing that comes up quite often is that if somebody's getting ready to switch jobs and it's a lateral move for them from just a position perspective, but maybe they're making more money, we can count that new income as long as we have an executed offer letter and obviously a start date. The rule is as a buyer, you just have to receive your new paycheck stub before your first mortgage payment is due on the new loan. Okay. Any questions that come up with income that we want to share with the group? Okay. So the question was, what if we have, what about if you have 2 W-2s, can you count both sources of income? So possibly. So, that kind of goes back to what I was sharing with you guys earlier. So if you can show that you've been on both W-2 jobs for the last 2 years, then we can use both sources of income. One question just kind of came to mind that I was actually just talking with a client on today. And obviously with what our communities have gone through with the changes with the pandemic and lost jobs and changes in jobs and earnings and all that stuff, the question came up was, if I had a down year in 2020 and just started to improve in 2021, are you going to count those years against me? And so not necessarily the case, because if we can show that now you're on a base salary in 2022, even though you had maybe half the earnings in 2021, we can count today's income. Where it could be challenging is if you're self-employed and you had down years in 2020, 2021, and now you're back up at 2022, we're still going to average those 2 years in 20 and 2021. That's for self-employed clients. Okay. I think I just answered this question, but we had questions come in. If the job in the first year was way lower than what you make now, that's say a 30K difference. So yeah, that kind of just goes back to my question. So if you have a big increase in your job, if it's a base salary related, then we should be able to use those earnings right away. Where it gets a little tricky is if you're in an overtime position or incentive pay like bonuses, any type thing like that have to be averaged 2 years. But if you just jump from 60K a year to 80K a year, that's completely fine. Okay, another question came in. Let me just read the question here. So we had one of our students partners was taking a break, staying at home as a mom, and going back to work, but not till next month. How can this affect the getting loan? So that shouldn't affect anything. So, with your spouse going back to work, we'll be able to count those earnings right away. Generally, as a lender, we're just going to want a letter of explanation as to why there was a break of employment. So obviously, she was on maternity leave, so that completely makes sense. And so that's easily spelled out, and then we can count the interest. Oh, she won't be going back to work. Oh, she won't be going back to it. Okay. Thanks for the follow-up question. So if she's not going back for a year, so that if your spouse is not going back for a year, then we're going to have to, so there's a couple different approaches. We could potentially, if she has a guaranteed position, then we can use what she's receiving in disability as income. And then if she's within 60 days of returning to work, we could potentially count what her new income is going to be. That one gets a little bit tricky, so I think maybe we take that one offline. If we can schedule some time or talk after the session. We can kind of talk more specifically about that. Okay, all right. Thanks for the question. All right, trying to manage the Q&A and present to you guys. So we're trying a new little format here tonight. So thanks for being patient with us. All right. And hopefully Melissa was able to answer your questions about the market. So hopefully we got that. If not, we'll get you her commentary on that as well. So we're going to still talk about income, and we want to look at now our expenses versus income. We call this debt to income ratio. This calculation is based upon our gross monthly income versus our monthly obligations like personal loans, credit cards, student loans, and the new mortgage payment that we're going to be paying. We usually don't want that debt to income ratio, our expenses, to be more than 43 to 45% of that pre-tax income. Now, for all of us joining tonight's call, if we're W-2 wage earners, we pay taxes. So you're probably not basing your monthly household budget off of your gross monthly income. So when you think about it, the 43 to 45% is a pretty aggressive approach. So I'm not a huge fan of that calculation, even though we have to use it to see if our clients qualify. When we look at this calculation and I meet with clients, most of our clients feel comfortable around a 33 to 36% debt to income ratio. That's where I think more of an affordability range looks like. The affordability level is going to be based upon, where you feel comfortable. So if you're used to paying $2,000 a month in rent and now you're jumping up to a $3,500 mortgage, we got to see if that's something that you can sustain. And so we want to make sure we talk through that. Here's what the calculation looks like though, but with debt to income ratio. So we're going to take the principal and interest, our taxes, our insurance, PMI, plus any HOA expense. That's going to come into play if I'm buying a condo, maybe I'm buying a townhouse, and let's say that's $2,500 per month, plus any additional expenses that I have. Let's say auto loans, credit cards. If that's $500 a month and I'm making roughly $8,500 a month, if I take those obligations divided by my monthly expense or my monthly income, I'm looking at a 35.9 debt to income ratio. Okay, and that's well within the qualifying. And like I said earlier, that's probably where most of our first-time buyers feel comfortable. Now, you have the calculation yourself. If you want to spend some time kind of going through that yourself, it's great. However, during a consultation, we'll take you through that math, make sure you feel really comfortable. One of the things I talk a lot about during our consultations is just making sure our expenses are in there right, especially when it comes to student loans, because we want to make sure that we're counting a realistic monthly amount for you with that student loan obligation. The next component to home buying is our assets, our down payment, what we have saved. As you learned earlier, we're going to have to save up for our down payment plus our closing costs. So when we look at some of the acceptable sources of down payment, those include checking and savings accounts, retirement accounts. In fact, gift funds are even available or eligible, I should say, if you do have a family member willing to help out with your home purchase. Let's talk a little bit about checking and savings accounts. Usually we're going to want to see the last 2 months of statements. Cash deposits are not acceptable. So if you just deposited $5,000, that's not seasoned and we can't paper trail that. So that would have to stay in your account at least 60 days for it to be able to be seasoned. If there is any large deposits, we got to make sure that we can paper trail where those have come from. Now, if you've simply just transferred money from your savings to your checking account, that's totally fine. But if it's just coming in from an unknown source, that's something we're going to have to paper trail. Retirement accounts can be used, 401ks, 403bs, IRAs, those are all allowed. But I would just caution you when it comes to accessing those type of accounts, because especially with IRAs, that you could have some tax implications with accessing those accounts. Now, when you take out money from a 401k or a 403b, you're basically taking a loan out against those accounts. When you take out that loan, it is pulling whatever that amount is out of the market. So you're not going to be able to reap the appreciation that you can have from whatever that investment is in. And then gift funds, as I mentioned earlier, that's where you have a family member that helps you with your down payment and closing costs. Gift funds do not have to be seasoned, but they do have to be paper trail. So we just have to make sure they come from a viable asset account. So when we look at home ownership, and as I consult with clients, our average first-time buyer not using assistance programs probably needs anywhere between $20,000 to $25,000 out of pocket to be able to purchase. And for most of our first-time home buyers, that can be a bit of a stretch. In fact, there's really kind of 2 challenges that come into play with first-time home buying. It can be kind of a limitation because of maybe where I'm at from a credit perspective, but more so it's around assets and how much I have saved. And so we partner with CalHFA, which is the California Housing Finance Agency. Probably many of you that are joining tonight's discussion heard about our class because of CalHFA. And so what we always like to do as part of our sessions is to talk a little bit about the program and how it can benefit you. Just this past Monday, CalHFA launched the Equity Builder program, and I'm going to speak to you a little bit more about that in just a minute. Leading up to Monday, we've always offered the My Home and the Zip Assistance Program, which are fantastic tools to help our first-time home buyers. In fact, in the Sacramento market, you can earn up to $180,000, which is still considered low to moderate income, and have assistance that can help you both with your down payment and your closing costs. Let's take a look at what that kind of looks like. So we learned tonight about the conventional loan and the FHA loan. The conventional loan and with My Home, coupled with My Home, you can get up to 3% of your sales price in down payment assistance. For an FHA loan, you can get up to 3.5%. It's a low interest, simple interest loan at 1%. And it's not required to be repaid until you either sell your home or if you refinance in the future. So it's a really great program. Now, as we learned earlier, to buy a house, we not only just need our down payment, but we also need closing costs. And that's where the Hfa Assistance Program comes in. It allows you to borrow up to 2 to 3% of your loan amount in closing cost assistance. Interest-free. It's also deferred payment. So until you sell or refinance in the future, you don't have to pay back the assistance. Really great tool. And so we've offered those products for the last several years. And now, just like I mentioned last Monday, we launched the Forgivable Equity Builder Loan. And this is a great tool. So it's designed to help more of our low-income housing clients. So if you make less than $72,000 per year in the Sacramento area, you can get up to 10% of your purchase price or your appraised value, whichever is less. And this is a totally forgivable loan as long as you stay in the house for 5 years. So if I buy a house for $400,000, I would get up to $40,000 in assistance towards my down payment and or my closing costs. So the $72,000 income limit is basically less than 80% of the area median income here in the Sacramento area. I know we have Los Angeles in here. I think we probably just missed that, but that Los Angeles is $68,880. But Sacramento, believe it or not, has a higher AMI, so we're at $72,000 in the Sacramento market. Now we can't add this in additional to My Home and Zip because it is 10%, but it provides more than enough support for our clients to be able to put. Basically, you can buy a house with no money down. This is a slide that we've always kind of shared with part of our workshops because it kind of shows you how the CalHFA, Zip, and My Home Assistance can help you buy today. And so like if we looked at a conventional loan and let's say we have a sales price of $450,000, the minimum down payment is $13,500. With the My Home Assistance Program, you would get that entire down payment covered. And then closing costs generally on a $450,000 house are anywhere between, let's say, $9,000 to $13,500. So I would probably need about $22,000 to maybe $27,000 if I didn't have assistance. But if we look down here at the bottom of the slide with My Home Assistance covering the down payment and then maybe utilizing the Zip assistance of $8,700 to $13,000, now I can get eligible assistance to help offset a good majority of the cash out of pocket with a conventional loan. Now, this is truly a conventional loan. So I know we had the question earlier about an FHA loan and maybe the limitations of being able to get an accepted offer. This CalHFA loan is a conventional loan, so it works with the same timelines as a normal conventional loan. Just as the CalHFA FHA loan will function just like a typical FHA loan. So when we look at the example for FHA, we buy the same $450,000 house. Minimum down payment is $15,750. Closing costs same, $9,000 to $13,500. The CalHFA Assistance Program would work the same way. So you now would get your full down payment covered of 3.5%. This actually needs to be updated too for us. So there is no max of $15,000. So this would cover the full $15,750. We would also get the Zip assistance. And so now we would allow ourselves to be able to have a majority of our expenses covered through the assistance program. Okay, so we had a question come in. Does using CalHFA assistance hurt your ability to get an offer accepted? Love the question because I probably get that question every day. And we're actually the leading provider of the CalHFA program. And what's interesting, as I work with clients across the Sacramento area, all throughout California, it really hasn't limited the competitiveness for some of our buyers. I think what's more so important is the timelines of transactions. How quick can we close escrow, which these will work just as quickly as a traditional loan. And then what we call is the contingency timeline. We're going to talk about that in just a bit, which basically means some of your due diligence that you're going to have to do as a buyer. But really, to answer your question, I don't really see it as a limitation or hurting us with the effectiveness. Especially, again, I think the market is trying to shift a little bit. So I think for us first-time home buyers getting qualified, now is a great opportunity for us to be able to present offers to sellers. So these programs do have eligibility requirements. The minimum credit score for CalHFA is 640. That 640 scores for FHA, 680 for a conventional loan. Now, if you're 80%, if you qualify under low-income housing, the minimum score for a conventional loan is 660. So that if you're below that, if you're at 72,000 or below, maximum debt-to-income ratio is 45%. Now, what's something an interesting kind of component of CalHFA is that this doesn't look at the household income, it looks at the applicant income. So why that's important is, let's say I'm trying to qualify for the Equity Builder program. Our combined income between my partner and I is $100,000. I make 60, my partner makes 40,000. If we can qualify just off of my $60,000 income for the Equity Builder program, then that's all we're going to look at for qualifying for this program. So the state won't consider the other $40,000 that my partner makes. So that's a great way of being able to be a little bit more inclusive for the program. Most assistance programs, especially some of the local municipality programs, look at total household income and dependents and whatnot. This simply looks at the income qualifications based upon the applicant. Now, for the traditional CalHFA, My Home, and ZIP programs, the maximum income is $180,000. So when we're speaking just the Equity Builder, it's up to $72,000 in Sacramento. The program in general, if you're looking for just the core assistance, is $180,000. And then a first-time buyer is actually someone that hasn't owned in the last 3 years. In fact, I was talking to a client earlier this afternoon. They own a house in Modesto as a rental property, but they've been renting in the Bay Area for the last 3 or 4 years. They're considered still a first-time home buyer. So if you maybe had a house in 2010, you've been renting ever since then, you're still considered a first-time home buyer. Okay. All right, and I can go back to CalHFA if you do have any other questions about that. Like I said, we're quite familiar with the different nuances of CalHFA and how it can help benefit you. These are the income limits for the surrounding counties. So you're going to see everything pretty similar in the greater Sacramento area. Getting to San Joaquin, kind of similar to what you see with the income limits. The loan limits, the income limits go down a little bit based upon some of the income levels down there. And then when you get into the Bay Area, it's a $248,000, for example, in Contra Costa County. I believe in Contra Costa, median income is right around 109 for eligibility in the low income housing. So if you're joining us from the Bay, or you have friends or family maybe considering this product, there's slightly higher income limits there as well in the low income housing. Okay. Okay, I'll answer this question really quickly before we go into the 6 steps of home buying. So a question came in, is there any special low income family programs for consumers with disabilities? Not that I'm aware of. There's no special programs offered through the state. All the programs that are offered through CalHFA are either for low income housing or low to moderate income households in California. Okay, so we're going to talk a little bit about now the buying process. We call this our 6 steps of home buying. This is something we'll refresh and go through with you as part of a consultation. But we love to share this with our classes because it kind of gives you an idea. What does it look like to go from getting pre-approved on a house to what are all the milestones that I'm going to have to go through before I get the keys to my home, all the way at the very end of the slide here at step 6. So I want to walk you through what these milestones look like, and I'm sure this will probably spark some questions for you. But the first step in our process is our pre-approval. And that is basically a certificate that's provided to you that shows a potential seller that you're eligible for financing. The pre-approval certificate is usually good for 60 days. However, it can always be recertified at any time, especially a lot of our clients that got pre-approved in 2021 are now looking for recertifications. We can do that at any time. The pre-approval is also adjustable based upon your offer price. Some of our realtors like to have those pre-approvals updated to match their offer price. So at the end of your consultation, let's say you get pre-approved for $400,000, but you fall in love with a house for $375,000, and maybe you don't want to show the seller that you're eligible for $400,000. We can always adjust that pre-approval to match your offer price. Okay. Now the pre-approval certificate is the output of a consultation. So we're going to go through a consultation, design a home buying game plan, and then once we've agreed on what it's going to look like for us going forward, then we'll issue the pre-approval. Step 2 is going to be house hunting. That's the fun part. That's when you get a chance to partner with like a preferred realtor like Melissa Allman. You'll do a consultation with her and kind of just figure out what are some of the neighborhoods that you're interested in. What's your commute time look like to work? What are all the characteristics that you want to see in the community? And that's where a realtor can really help you with that. Once you've kind of figured out what the right filter looks like for you in terms of different properties you would consider, once you've identified a few properties that you want to go and check out, that's where a realtor would help you with that home search. As I mentioned earlier, we'll update pre-approvals based upon what you decide to offer on a home. Once you've kind of set your sights on a home that you love, obviously in this market, we got to act kind of fast just because this is a very competitive market. So it's usually you see a house and you have to kind of make a decision of something you want to go forward with, I would imagine probably in 24 to 48 hours. Let's say we make an offer on a house the offer gets accepted. Then we move to the next milestone. That's called entering escrow. That means we have a ratified agreement with the seller. And it usually starts what we call the escrow time period, which is usually 30 days. So the seller's accepted our offer. Now, the next task that we have to work on as a buyer is we're generally going to have to make what we call an earnest money deposit. That earnest money deposit is usually 1 to 2% of our overall sales price. Now, that money goes towards your total out-of-pocket expense. But as a buyer, you're expected to make that deposit in the first 2 to 3 days of that escrow time period. So day one starts today. So let's say today's April 6th. By April 9th, we should have made our deposit into escrow. Now, same day of your accepted contract, worst case scenario, 24 hours, you're going to get a call from myself or one of our team members to schedule you for your follow-up consultation. That's where we're going to get back together on video. We're going to talk a little bit about your contracts, the timelines that we have to meet. We're going to order your appraisal of your property, and we're going to review all your disclosures for you to make sure you understand what your product options look like, interest rate selection, and whatnot. And then once we've completed that follow-up consultation, we're going to send your initial e-disclosures to you. This is the slide that we'll share with our audience that kind of frames up what earnest money deposits look like. Like I said, they're 1 to 2% of your purchase price. The funds that you deposit count towards your total out-of-pocket expense. And the last thing I want to kind of point out with earnest money deposits, it's protected generally by a contingency. And the contingency allows you to do your due diligence as a buyer in the first 14 to 17 days of your contract period. And so those are pretty important. I think you heard me mention something about contingencies earlier today. So when we think about being competitive in our offer, and Melissa can maybe chime in on this as well, is that maybe the shorter we can make our contingencies, the more competitive our offer can be. That also holds true with the close of escrow time period. So traditionally, a close of escrow is 30 days. But if we can shorten that up to maybe a 21-day close of escrow, and maybe our contingencies are 14 to 17 days, that will help maybe the seller decide to choose our offer, right? So the appraisal contingency is we want to make sure we get the appraisal completed. We want it to match the offer, the agreed upon purchase price. Inspections are going to be, and I think Melissa just chimed in, usually within the first 8 days, 7 to 8 days of the accepted offer. Loan contingency, that allows you to get your loan approved. We're running loan contingencies about 10 days right now. Appraisals about 14, just depends on where the property happens to be located. Unfortunately, in some of our more remote areas, appraisals are just taking a little bit longer just because of the demands of the market. And then there's just a limited volume of appraisers out there. Okay, so that's step 3. Step 4 is going to be processing and underwriting. That's where our team does more of the administrative tasks on the loan. We verify income, we verify assets. We're going to have your rate locked by that time, especially in this volatile market. We really want to get the rate locked ahead of time. We're going to talk about strategies around that during your follow-up consultation. And then we're going to go ahead and now move to the next milestone, which is your loan approval. That means an underwriter has reviewed your income, your assets, your credit, your loan program, make sure it's a good fit for you. And so that's a big step in the process because that takes us about 3/4 of the way through the escrow time period. If everything checks out for your loan, you're going to be able to remove your loan contingency. If the appraisal comes back okay, we'll remove that contingency. And assuming your inspections are good, then you'll also remove that contingency. Now, what's really important to note is when you remove contingencies, that tells the seller that you're kind of all in on the transaction. So at that time, now your deposit is in play. So if you decide to cancel the transaction, let's say a couple days after removing contingency, you could potentially risk losing your deposit. So you really want to be careful with that. And that's why it's really important to partner with a realtor that will help kind of guide you through that. At step 5, we're going to issue to you a final closing disclosure. It's going to give you a 3-day cooling off period before we get to the very last milestone, which is step 6. Now, throughout the process, you're going to be getting different iterations of disclosures. Especially for our clients that are using assistance programs, there's multiple sets of disclosures because you have the My Home Assistance, the Zip Assistance Program, in addition to your first mortgage. So just something to keep in mind. So let's say we've signed our closing disclosure. We've gone through our 3-day cooling off period. Now the big day comes. That's called the closing of our loan and signing our final loan documents. And everything up to that point can all be done via e-signature. But when we get to step 6, we have to sign documents in front of a public notary. So that's an in-person appointment. That process of signing usually takes an hour or so. And then after you've completed that, you'll be wiring in the final funds that are owed in your transaction. That money gets reconciled by what we call the escrow company. And then the documents that you have signed to get returned to us for a final audit from our closing department. And once everything checks out, then we wire in the funds for the first mortgage, as well as your assistance programs if those are elected. That escrow officer, again, takes and reconciles the funds to make sure as a buyer, you're contributing everything that you're supposed to. If everything is accounted for, then what they're going to do is they're going to transfer recordable documents to the county recorder's office. For those of you who are buying in Sacramento County, it's like a block away from our office here. They record a grant deed that transfers ownership to you. They also record a deed of trust, which is your agreement to repay the loan. And once the escrow officer gets confirmation of that recording, then you become the official owner. You get a chance to connect with your realtor, get your keys. You go hold your sold sign in front of your house, high five, you post on social media, all that fun stuff. It's a big celebration, right? It's probably one of the biggest investments you're going to make in your lifetime. So that's what it looks like to go from pre-approval all the way to buying your house. Okay. Now, if you're ready to move forward, you want to kind of set up a consultation, we'd love to be able to connect with you. And that's a 30 to 45-minute session. It starts with a really simple online application. We only do a soft credit pull in beginning that process. You'll upload documents, and then our team will connect with you to make sure we have all the needed information for you to be prepared, so we get the most out of our consultation with you. So, and that consultation will be done with me either over video, over phone. So I'll be hands-on designing your home buying game plan. Now, leaving today's session, if you just have some questions for myself, maybe Melissa, and you just want to kind of know a little bit more about the market or talk more about interest rates or explain your situation a little bit more, love to be able to connect with you for an intro call. Whatever direction you want to go, you can schedule those appointments just using this link below or visiting our website. We can make sure that we get you connected with us somehow. This is what our consultation looks like. So this is kind of the framework of our home buyer consultation. So understand a little bit more about where you're at from a housing perspective. Where do you want to go with some of your goals? We'll talk about budgets, locations, look at your application, look at different scenarios with interest rates and closing cost structures, walk you through that 6 steps of home buying, get you fully educated up. So by the time we leave that session, we have a plan together. And then we, of course, will want to issue that pre-approval letter so you can start your home shopping whenever that is, whether that's next month or next year. At least you'll have a plan in place to be able to move forward with that move towards home ownership. We have some great resources available to you, as well as our mobile app. So this allows you to even start the application process right from your handheld. You can upload documents, you can track the progress of your mortgage, and you can even run different calculations. So if you're out home shopping with one of our preferred realtors, you can go in and run some payment calculations, and those will give you some pretty true numbers. You may be joining us through one of our partnerships. That's maybe how you found out about our classes. We have partnerships across the, different universities in California, as well as out in Virginia, believe it or not. We also have a discount program available for state employees. So if you've seen us on the state calendar, you'll see our state discount program available to you. We offer these free consultations because we really want to help be a partner for you in that journey towards home ownership. So this isn't something where it's an obligation type of thing. We just want to help build a plan for you and be your trusted mortgage advisor. So with that said, I want to kind of share with you just some of our workshops that are upcoming. So if you want to learn a little bit more, maybe just didn't get enough information, we do post our videos on YouTube, so you can check out that and subscribe to our channels. But we're also teaching other classes that are upcoming. So you guys you're a part of this April 6th class. We're teaching another class next week for our Bay Area residents. As well as classes throughout the balance of this year. So, we'll be teaching plenty of classes. So if you want to kind of a tune-up or whatever, please feel free to visit us at mortgageeducate.com. Also invite coworkers, friends, family. We'd love to have them join us as well. Here's all my contact information. So if you want to get connected with me after today's session, feel free to reach out, message me at any time. Love to be able to help be a partner for you on that journey towards homeownership. So with that said, I really want to thank everyone for joining us tonight. I want to thank Melissa Allman as our preferred realtor for answering some questions for us. Speaking of questions, we're going to stick around tonight so we can answer those questions. One quick thing before I open it up for questions. I really encourage you to follow us on some of our social channels on Facebook, on Instagram. We love to celebrate homeownership. So when you get the keys to your home, we'll be the first ones to celebrate with you on our social channels. But we also like to post a lot of great content there. In fact, when we launched the Equity Builder program this week, that was one of the first things we posted on some of our social channels. So you'll see Ken getting some of that information out to you. And so definitely, if you can, follow us. And the final thing is I want to share is, this is probably one of the biggest investments of your lifetime too. And so we want to be that trusted mortgage advisor. And so we love what our clients are saying about us. So please check out some of our reviews on our Google, check out some of our Yelp, because we're really proud of what our clients like to say about us, especially some of our graduates from some of our classes. So with that said, I'm going to open up to questions. I think I may have one. Okay, so question just came in. This is a good question. So do we still need to take the first time homebuyer class even after the workshop? So the answer is yes. So this isn't like a credentialed class. You do still have to take the e-housing class. What we recommend taking that class by the time you at least get to step 3 in the process. During your consultation, we'll provide you with all the link information, or we can send it through the presentation. That's a good question though. Maybe one day our class will be credentialed, but at this point, it still needs to go through e-housing.